In our society, we often tend to judge people by their appearance. Our initial impressions can often be right. If we like what we see, we're generally more inclined to spend time to try and get to know them better.
Excuse me, Mel Gibson, can I have your autograph?
Oh, not a problem. There you go. Who am I trying to kid? But first impressions can be wrong and appearances deceptive. So what measures should we use to assess businesses? Are they a good business because they have flashy offices, shops or showrooms? Are they a good company if we like the look of the products and services they offer? These may be reasons why we do business with them, but the most common measure for actually judging a company is profits. But why are profits important? Well, because the rule of a capitalist economy is make a profit or go out of business. So how do you get to know a business? Well, you could try having a detailed chat over a cup of coffee with the managing director. Thanks for that. But this obviously isn't particularly practical. It could also lead to allegations of insider trading and some serious legal issues. No, the accepted way to get to know a business, a company, is through its financial statements contained within its annual report. Specifically, the statement of financial performance, the statement of financial position, and the cash flow statements. All are important and show different aspects of a business's performance. But the first question is likely to be about profit. Specifically, is the business making a profit and are those profits growing year on year? If so, this will give us an initial indication that the company is healthy. But why are profits so important?
Profits are extremely important to a company as they signpost whether or not they're operating effectively and efficiently.
Profits are important for several reasons. One, because the shareholders would like some sort of return on their investment, so you are unable to give them that return unless you make some profits.
Often you might find if a company is going through high growth, they may wish to reinvest a lot of the profits or alternatively dish them out in dividends to their shareholders.
Profits are also important from the perspective that you will need to reinvest, so you need to have profitability and therefore strong cash flows to reinvest for growth in the future.
To get an idea of the importance of profits and losses, let's look at two companies in the telecommunications industry, Telstra and the now defunct OneTel. Profits are revenues minus expenses. A company in this area earns much of its revenue from customers paying to use their services, their business and home phones, mobiles, internet access, etc. The expenses are things like wages, depreciation, rent and things like that. For the year ended June 30, 2000, Telstra had revenue of $20 billion and expenses of $16 billion, giving profits of $4 billion. For the year ended June 30, 2000, OneTel's picture was not as good. Revenue of $680 million, more than double the previous year, but expenses of $970 million, almost 3 times the previous year's expenses. This resulted in a loss of $290 million. This loss and the prospect of not making a profit in the near future may have prompted some of OneTel's major investors to refuse to invest more money to keep the company afloat. OneTel directors claim they were misled. But how could this be when accounting is numbers and those numbers either add up or they don't? Let's start with revenue. In the case of a public payphone, the cash is received and the revenue earned at the same time. But with other services, the cash is received before or after the revenue is earned. For a mobile phone, if you use the prepaid service, you pay up front and the phone company receives the cash before they provided the service. While for a mobile phone under contract, you may pay $20 up front, but they then give you a phone and you're now free to ring the world with nothing more to pay for over a month. So how does a company calculate what it's earned if it's receiving money for its services at different times? Do they just look at what's gone in and out of their bank account by a particular date? If they did, that would be cash accounting, a bookkeeping method used by many sole traders and other small businesses. Instead, a more common accounting practice is to recognise revenue when it's earned, not when the cash is received. This is called accrual accounting. This approach keeps accountants far busier and much more challenged. Why? Because it introduces some judgment or subjectivity, as they need to calculate how much revenue is earned in a particular period, in this case, in the financial year. With accrual accounting, as revenue is accounted for when the phone company provides a service, they're making the assumption that they will actually be able to collect the money for the service they provided. Sadly for OneTel, this often didn't happen. Credit checks do not appear to have happened as they should have, with the consequence that a large proportion of their subscriber base either couldn't or wouldn't pay their bills. For Telstra, bad debts were less than 1% of revenue. For OneTel, the figure was 5.7%, and we know this was even too low.
OneTel set up with the concept that they would be what's called a reseller of mobile telephony, and they rightly picked that this was going to be a booming market. And so they found in Optus a company that was willing to pay them $170 for each new connection they made and $120 for each new customer they would sign up. The whole culture was just to get the customers in the door, no matter how. They were standing on street corners handing out $10 to anyone who would sign on as a customer, and the whole focus was just to build as many customers as possible without really worrying about how you're going to manage those customers, collect the debts from the customers, and the whole system was just ended up in a nightmare.
So revenues for OneTel may have been overstated. What about expenses? Judgment and a level of subjectivity is also required for many expenses. A business builds or buys assets, things that will help them earn revenue over a number of years. Because many assets will contribute to the company's revenues for a period longer than one financial year, the total cost of the asset isn't allocated to the year in which it was bought. Instead, it's allocated across the useful lifetime of the asset and depreciated accordingly. So how do we measure the use we get from these assets in one particular year? It's not like using up a bottle of water where you can see exactly how much has been poured out and also how much is left. Measuring asset use requires estimates. How long will you use the item? What will it be worth when you sell it? And how much benefit did you gain this period? OneTel had $35 million in depreciation and amortisation. As it turned out, in 1999-2000, they had in fact received the majority of the benefit, and so were in effect deferring costs to future years. This can be seen by the way OneTel treated the cost of the phones as a deferred expenditure, an asset. And at 30th of June 2000, it had over $18 million worth of these. A business can succeed if it's well managed, if it's correctly financed, if it's marketed imaginatively, but it will only remain in business in the long term if revenues are greater than expenses. Some managers may have other incentives and motivations that encourage them to try and paint a rosier picture of a company's performance than reality would suggest. But ultimately, it's the accountants who measure the financial success or failure. That measurement is not always straightforward, and the results may not always be heeded.